Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And welcome back to another Q&A episode. As I said, I'm going to really focus on trying to answer as many of these questions as possible. They're always good and thought-provoking, and I hope you enjoy them too. And of course, if you do, please leave a rating, share the podcast, recommend a friend or a family member listen in. Whatever you can do to help me build the audience would be much appreciated. So let's take the first question then from James. So James writes, I'm 36 years old and invest in both property and ETFs. I've got two investment properties, one in Queensland and one in Sydney, and a small ETF portfolio. I know in the long term, the return in share markets and property markets is very similar. I like ETFs because they're low cost, simple, scalable, and liquid in nature. I like property now because of the power of leverage and it maximizes the capital gains. My question is, when leverage is no longer a factor, that is, the mortgage is paid off, should I sell my investment properties and put the money into the share market? Now, this is an excellent question, James, because there's probably more parts to this question than it first might appear. The question kind of implies that the only reason you invested in property is because of leverage. That's the main reason, I guess, that invites you to initially invest in property. But property in of itself can still be a wise asset to hold even in the absence of leverage. But also, it really depends on an individual strategy. And as I've said many times in this podcast, a property net of all expenses isn't going to yield you a lot of income. I mean, it is if you can hold it for 30 or 40 years. But say in the next 20 years or 30 years even, the income return from property isn't going to be great. So then it's a asset allocation decision, and if you get to retirement and all your wealth is held in the property market, yeah, you're probably going to have to sell at least one of those assets to build a little bit more liquidity, a little bit more income, a little bit more flexibility. But hopefully you can achieve that over time. James, to answer your question, I think, is in the first sentence. You said you're 36 years old. So your goal then is to maintain, because you're 36 years old and therefore 24 years away from accessing super, and let's say 24 years away from wanting to have the flexibility to retire. Now, you might say to me, it's sooner than that, but let's then, for the sake of the argument, call it 20 years. You've at least got a couple of decades up your sleeve. So don't repay any debt. Because you've got 20 years left, even if you didn't repay $1 against your two investment properties, they're probably going to be, if not positive cash flow, pretty close to it, and certainly pretty close to neutrally geared by the time you get close to 60. So your goal, to my mind, from what you've told me, isn't to repay debt. And in fact, if you get to a point where your leverage starts to become very low, then you might want to consider adding another property portfolio. That's the whole thing, is you leverage your equity as well and try and maintain or keep a reasonable level or appropriate level of gearing in your property portfolio. And you can do that by adding more property, obviously, and more leverage. So I think the answer is no. Just because and now if you happen to have a really strong cash flow and you repay debt against the property, as long as you've got other assets, and you're doing the right thing here too, James, you're investing in both property and shares, which I think suits or is appropriate for most people. As long as you keep doing that over the next 20 odd years as well, you're probably not going to get into a situation where you need to sell a property asset. And the property asset is quite tax effective because you're going to get most of your return in capital growth and little in terms of income. So even once there's no debt against the property, from a taxation perspective, it's not going to create too many problems because you'll have, a growing list of expenses, maintenance, land tax, these sorts of things that will sort of eat away at that income. So it's not going to be income heavy, if you like, and you're not going to pay tax on the capital growth, obviously, until you sell it. So it's tax effective from that perspective. Whereas obviously the ETF portfolio is going to have distributions, dividend income, that sort of stuff that's going to be more predictable, but you'll still have some franking credits as well. But it's a really good question, James, just because it brings up a greater question of what is your longer term strategy. And I don't think that just because, if I held a fantastic property that had produced great returns but had no leverage against it, whilst that might be suboptimal, it's probably not to the point where you go, well, I don't want this asset anymore. Great question, James. Okay, the next question is from Dan. Dan writes, I know you're not a fan of all listed investment companies or LICs. However, I was interested to know your thoughts on bonus share plan, or sometimes they're called dividend substitution share plans, that a couple of them offer, whereby shareholders can relinquish the right to receive a dividend and receive bonus shares of equivalent value instead. I'm earning in the top tax bracket, and I was looking at these investments of a way of reducing income received as a dividend and the additional tax they cost me, given I always reinvest the income anyway. What are your views? It'd be greatly appreciated. So just a couple of pointers here. For those listeners that don't understand what LICs are and why Dan would say I'm not a fan of them, listed investment companies, LICs, are similar to ETFs, but generally, not always, generally LICs are actively managed, whereas ETFs tend to track an index. And so ETFs tend to be low cost. And most importantly, the net tangible assets of the ETF match the share price or very closely track the share price, whereas LICs can often trade at either a discount or premium to their net tangible assets, which means that you've got a listed investment company provider and its actual investments are doing maybe well, but the market doesn't like it and the shares will trade at a discount. Now, some investors will go, oh, well, I'm going to buy it because I'm buying it at a discount, on the assumption that the market will one day recognize it's at a discount and the shares will trade up close to net tangible assets again. That doesn't always happen. So there's a couple of issues there: methodology, fees, and then trading at a discount. Now, what Dan's asking is it more tax effective to kind of relinquish my right to a cash dividend in return for getting shares? Typically, and these normally have a tax ruling, so the ATO will give you clarity on this, but typically, if you are part of a dividend substitution share plan, what happens is that the issued shares come to the cost base of the asset. So you don't pay any tax on that dividend, in inverted commas, until you just start disposing of the holding in the LICs. As a general approach we use within ProSolution and for our clients is we don't use any dividend reinvestment plans. We don't automatically reinvest income in the product that income has come from. Instead, we take all returns as cash and then decide where we want to allocate that. And the main reason we do that is it gives us an opportunity to rebalance a portfolio. So, for example, if I've got something that's producing some income, let's say I'm investing in the S&P 500 in the US, and I get some dividends from that investment, well, I'm not going to put it back in the S&P 500 at the moment. It's all-time highs. If you look at long-term trends in terms of PE ratios and CAPE ratios, all those sorts of things, that market looks overvalued, but emerging markets look cheap. So I'm going to take my US dividends and then invest them in emerging markets, for instance, just as an example. And so that's why we don't like using DRPs or automatic reinvesting of income, because we want to always avoid having to sell investments to rebalance. And instead, we use that new cash to try and rebalance a portfolio as much as possible. I don't like LICs because, for the reasons I spoke about, higher fees, performance tends to lack, and potential to trade at a discount to net tangible assets. They're the three main reasons we don't like them. So even if they look more attractive just because they've got this dividend substitution share plans and you don't pay tax on the income, my argument would be, choose a better investment. And then you can also choose investments, that will minimize the income return and in return for maximizing the capital growth return. And I think that's a better process. Now, if you already have a lot invested in these LICs and you form a view that's going to be different to mine, that this is going to be a good long-term investment, then sure, if you're in the highest marginal tax rate, Dan, take the shares instead of the dividend, especially if you've got nothing better to do with that income, and reinvest it. It's not going to avoid the tax. It just kicks the can down the road. You'll have to pay the tax eventually, but maybe less tax potentially if you're going to sell in retirement rather than when you're working. But great question, Dan. And, sometimes we get distracted by the ancillary benefits of an investment, which kind of seek to kind of mask over some of the weaknesses of the investment. I think this is Perhaps some people say putting lipstick on a pig. I think it's putting lipstick on a pig, and I just wouldn't invest in the pig, Dan. Hopefully that's not too subtle. I don't think it is. Okay, next question is from Dan. Dan writes, we have a significant amount of stock in the US market. One thing that causes us concern is the possibility of a significant rise in the Australian dollar and the resulting impact that will have on the value of our investments, independent of performance of the underlying assets. We are close to retirement in the next few years and are considering selling down some of these investments to manage the risk of a rising Aussie dollar. Do you have any insights into what we can expect over the next 1, 3, and 5 years with respect to the value of the Australian dollar and the drivers that would increase its value? Well, forecasting currency is, most economists will say, is easily the most difficult one to forecast just because there's so many inputs, both domestically and internationally. It's really challenging to do. But let's talk about hedging because, it's something I haven't written about and maybe I should do an episode on it. For those that are listening, hedging is seeking to minimize the impact of currency changes. So at the moment, investing in an unhedged basis is kind of risky because at the time of recording this podcast, the Aussie dollar is worth 66 US cents. The long-term average of the Australian dollar is around about 70 cents. So it's undervalued compared to the long-term trend. Therefore, if I make some investments today in the US market and the Aussie dollar trends up to 70, 72 cents, whatever it might be, that's going to actually reduce the value of my investments by around about 10% or whatever that movement in the currency is, holding everything else equal or constant. So that's a bit risky. Whereas when the the Aussie dollar, I should say, was parity to the US in 2012. It was a great time to invest in the US because arguably the US dollar was undervalued. It would eventually, reversion to the mean means it will eventually improve in value. And so then you get not only the stock market returns, but then you get the currency returns as well, which is really valuable. When you have a look at, all the research around hedging, is it worthwhile to hedge your investments? All the research says it swings and roundabouts and it all kind of end up in the same place at the long run, over the long run. So you'll have periods where the Aussie dollar is trading below 70 cents and periods where it's trading above 70 cents. But, in the long run, everything sort of evens out. The view we take internally is we're only really mostly concerned about new capital. So that is, if I'm making an investment today and the Aussie dollar is trading at 60 cents, then my risk is significant that the Aussie dollar is going to trend upwards. And if I'm putting new money into the market, I want to hedge that investment. Whereas if the Aussie dollar is at 80 cents, well, then better chances I've got more upside than downside. I'd go unhedged in that situation. And so the question that Darren's asking, he's saying, well, because the Aussie dollar is quite cheap at the moment relative to the US, my risk is that if the Aussie dollar does actually trend, say, to 72 cents, which is a 10% increase and arguably a bit of mean reversion, the value of his investment is going to fall 10% as a result of that. And I guess what I'm saying to him is it's really hard to forecast these things. If you have a look at the forecasts from all the banks, they believe by the time we get towards the end of 2025, the Aussie dollar will be in the 70s. Now, what are the things that are going to make that happen? Well, possibly if the Fed keeps on cutting interest rates how the market kind of expects that they will, and the RBA is reluctant to start cutting rates here in Australia until, midway through next year, well, the disparity in interest rates might appreciate the Aussie dollar. But a big thing to consider is commodity prices. When commodity prices are higher, China and other buyers of our exports need to buy more Aussie dollars. Conversely, when iron ore prices are relatively low, which they have been this year, I mean, they're off their September lows, but, so iron ore is still relatively low, about $100, whereas last year it sort of got up to $140. So that has an impact on the demand for Aussie dollars. And then China's appetite in particular for our resources, when its appetite is low, it obviously doesn't need as many Aussie dollars. So I don't know though, Darren, if the outlook matters too much. I think I'd be playing the averages. And this is a really good question, Darren, because it has many applications in terms of the methodology and approach, has many applications. Quite often, as Darren is, we're faced with questions, financial decisions to make, and we're worried about the short-term implications and what to do over the next period of time. So Darren said they're a few years away from retirement, so they really don't want to have too much volatility in their investments, of course. But really, the best way, it's really difficult if you're going to be short-term focused. What should I do in the next 12 months? So the best way I find is always to take a long-term approach. And it's something I talk about in the podcast a lot, but this is how you can apply a long-term approach to answering what is a short-term question. So the way I'd answer it, Darren, is I would say, okay, you're pretty close to retirement. At some point in our life, capital preservation is more important than investment returns. That's not true when you're in your 20s, but it starts to become a lot more true as you get closer to retirement. Your appetite to lose money is greatly reduced, even if it means that you're going to take a little bit of a haircut on your investment returns. The other thing I would say is if you've got a significant amount in the US stock market, over the last 10 years, you've done extraordinarily well. Okay, so the investment's performed really well. And if we look at mean reversion, we can say over the next 10 years, it's unlikely to perform as well. Now, of course, no one really knows what Trump's going to do and what impact that will have on the stock market, but let's just play these longer term averages. The other long term average is the Aussie dollar is undervalued relative to the US. Now, it might be technically fairly valued, but I'm talking about relative to long term trends. So you've done really well in this investment. Your appetite for volatility is much lower than it was when you're in accumulation stage, and the Aussie dollar is pretty low. So your downside risk, which is, the Aussie dollar appreciating, is quite significant. Your upside risk in terms of hanging in there for more returns from the US stock market or the Aussie dollar to continue to depreciate, I wouldn't say there's a lot of upside there. So what I would do if I was in your situation is, if it's possible to do so in a tax effective way, I would reduce my US market exposure, but I'm tipping that you're probably facing a bit of capital gains tax. So then it's a question of, what do you do? Do you wait until you're retired before reducing your US market exposure and therefore hopefully minimizing capital gains? Or do you do it now? I think the answer to that question, it really depends on what your other assets look like, how much wealth you have, whether you've got, likely to have surplus wealth or a deficit. There's a lot of other sort of questions. I would imagine it's not a black or white answer either. I imagine you probably should make some changes, but it's to what extent do you make those changes? I'm not really sure. I think what I would ask you or put to you, Darren, is, could you stomach a 10% drop in terms of the exchange rate? And if it did happen, are you happy to hold that investment for the long term? Because currency will even out in the long run. And if you are a long-term investor, then you probably don't really need to worry about it too much, sort of contradicting myself a little bit. And so if I said to you, look, why don't you just hold that investment for the next 20 years? Would you be happy to do that, knowing that there's going to be times of volatility like there are in all markets? Chances are in 20 years' time, in Aussie dollar terms, your investment's probably going to be worth a lot more than it is today, although the next 10 years probably will be under. Anyway, they're just some of the things I think about when sort of faced with the question. Always difficult to give definitive answers here because obviously I don't know the full circumstances. Okay, next question is from Peter. Peter writes, most financial commentators believe that markets are overpriced. My question is, how much do you think forced savings contribute to that? I'm referring to things like superannuation, retirement funds, worldwide university and college endowment funds, and other massive stores of wealth, all of which need to be continuously invested. Plus, there's a growing number of individuals that don't believe they'll ever crack into the property market, instead put their money into shares. It's a good question, Peter. The thing to realize is, some of these really large super or retirement funds or endowment funds, and there's a lot of sovereign wealth funds, for example, where countries are investing their money. A lot of these really large institutions invest in unlisted assets. Because they have so much money to invest, they can't just go into particularly the Australian share market. They would move the market. So because they've got so much money to invest, they tend to invest quite a bit in unlisted markets. So we've got to think about that. And I guess the flow of capital has always been there for at least the last 100 years. The question is that flow of capital more today than what it has been in the past? Well, you probably say yes from an Australian superannuation perspective, because that started in 92 at 5% of someone's salary, or could have been 4, I can't remember. Next year it would be up to 12%. So that's been significant, but that's really unique to Australia, and I don't think it really moves the global dial. I think capital flows into markets are certainly increased, but I don't think they've really contributed to, where the stock market is. I think we're, low interest rates for a period of time over COVID, the amount of quantitative easing that occurred, the amount of money stimulus that was spent into the markets, that's obviously had a massive impact. And then you've got technology and things like technology and AI and those sorts of things. You've got businesses like Apple that earn or generate, I think, 2.3 million US dollars per employee. That you get businesses like this, they're behemoths, in terms of profitability. And I think that also contributes. We've probably never had, it'd be an interesting question, have we ever had something like that in history? Have we ever had a company of that size that's generating $2.3 million per employee? My gut feeling would be no. And so I think, Peter, that's probably what's contributed to it. I did put something on X or Twitter, whatever you want to call it, over the weekend, wondering how much the increase in the superannuation guarantee rate, so that's the amount of compulsory contributions employers need to make, what impact that has had to wage inflation in Australia over the last, say, 5 years. Because wage inflation in Australia has been, well, up until the last couple of years, pretty benign. And if you look at the long-term sort of data, it's relatively low. But of course, people have been getting increases that haven't hit their pocket, their cash flow, through the result of higher super contributions. So that's kind of interesting question, but completely unrelated to Peter's question, so I'm not even sure why I mentioned it. Okay, next question is from Jason. I feel like I say this all the time, but it is a really good one. Jason writes, my question is about your clients and if you'd be willing to potentially share some examples where things haven't gone well in terms of returns. I've heard several examples in your podcast and the results you and your team have achieved for clients are truly amazing. I'm just wondering if this is the norm for your clients to start working with you and they have their super triple in nearly 10 years' time. Thanks, Jason. It's a good question, Jason. What hasn't gone well? I think there's a couple of investments that haven't, that I think are fundamentally sound, that haven't performed so well, and that I've covered in the podcast. I think it's really important to, call out, some of these circumstances, because we can learn just as much, I think, from, I don't know if I'm going to call them failures, because I'll explain them in a minute, because I don't think they're failures. I just don't think we've held them for long enough. But I think we can learn from investments like that, as well as learn just as much from investments that work out. So the two that come to mind, the one big one is that, 10, 12, 15 years ago, a lot of our clients were investing in apartments, investment grade apartments in Melbourne. And I've spoken about this a lot, so I won't go into it in this situation, but they haven't performed well. In fact, they're terrible investments. If we had our time again, we wouldn't have done it. Now, for lots of different reasons, I think they'll probably be one of the best performing sectors over the next 10 years, just from a pure value and affordability perspective. So I think those investors, the ones that have been patient enough, and that's most of them, to hang on and hold on to that investment for a longer period of time, it'll be fine. Like, it wasn't a mistake per se, but we also didn't have the same financial advice proposition as we do today. We weren't as comprehensive, I think, going back, say, 15 years ago. So that's partly an issue as well. So that's one of them, though, that certainly if we had our time again, now we probably wouldn't have made those investments. The challenge is, though, what else would have you invested in, Stuart? Because a lot of these investment grade apartments we were buying at that time, we were buying for between 450 and, say, maybe 600, even 550. A lot of them were in that price range. What else are you going to buy in that price range, right? So that would have been the challenge, but that's one thing. And over the last couple of years, we've made some investments into some unlisted office investments here in Melbourne. And again, this only been after a couple of years, but it's been a terrible couple of years in office in Melbourne. Now, the long-term signs are looking fantastic, even despite Melbourne being kind of on the nose a little bit in the work from home thing. But the reality is that the valuations of office buildings in some situations, or in quite a lot of situations, in fact, the value of those assets are significantly below replacement cost. So what it would cost to buy the land and build the building. Quite often, they're either half or 30% of what it would cost to replace that asset. That's what they're valued at today. So, it's been a very tumultuous period for office. I think in Australia it's been challenging, but particularly in Melbourne, and that hasn't worked as well. Again, a little bit of a timing thing. We could never have seen or predicted COVID, of course, and the impact of that. But if we had have been able to predict that, yeah, maybe we probably wouldn't have made those investments. My thesis, though, Jason, is really important. My thesis is that investing mistakes don't happen as a result of random bad luck. And this is the thesis behind writing the book Investopoly, is to come up with a set of rules. And if you follow these rules, it's really difficult to make a mistake. In fact, I would say you just can't make a mistake. Now, it might happen that you make an investment and after 10 years or 5 years or 2 years, you're not happy with the returns because we can't control markets. That can happen. But if the thesis was to go and buy this asset, or the methodology, buy this asset and hold it for 20 or 30 years, then it's unfair to make that assessment only after a couple of years of holding the investment as well. So investment mistakes are made as a result of doing something fundamentally incorrect. And then it's just about, distribution of returns and how it works. So I think that's why the case studies have been really good, but not every investment has performed as expected over that time period. And that's something that I will certainly admit and highlight, but also it's good. And it's one of the reasons why I wanted to share the case studies so people have realistic expectations, that you're going to make 3 or 4 different investments and they're going to perform differently at different times. Now, you hope that when you wake up in 30 years' time, they've all performed really well. And I think that's a reasonable expectation. But, after the first 5 years of ownership, some are going to shoot the lights out and some are going to be pretty average investments. And in the short run, that's how investments behave. But that's why you spread your money across different asset classes, different, investments, to have that level of diversification. The way we look at working with clients, though, Jason, is that we do look on a 10 plus time horizon, 10-year plus time horizon. So we want to make sure that if we work with a client and they pay our fees over the next 10 years, that in 10 years' time, they look back and go, that was a no-brainer. And that's really important to us. We need to make sure we've got plenty of scope to add value, and that, in fact, that's going to be the outcome. And I'm confident that will be the outcome in, if not every single client situation, at least 99% of them. Great question. Okay, I'm going to squeeze in one final question from Kieran. Kieran writes, you've mentioned projecting land tax liability as an important consideration when considering the long-term holding costs of an investment property. There's some negative sentiment with Victoria with recent land tax increases, and I'm told there's increases in investor sales. One can now purchase an investment property in any state more easily. That's true. His question is, when I use online calculators for the equivalent land value of Queensland, it's more expensive than Victoria. This seems to counter to the market narrative and sentiment. I wonder if I'm missing something. Are there other significant costs associated with holding an investment property in Melbourne? Maybe it's lower yield or tenancy reforms. The difference in sentiment between, say, Brisbane and Melbourne seems to be a little out of keeping with the holding costs that may vary for a similar land size. It's a great question, Kieran, and you're right. I like to think about, how will land tax behave in the long term? And it's something that we include in our financial model in terms of projecting how that will behave. I'm not sure. It's going to depend, I guess, on sort of what land value you use, Kieran, because on $1 million, the land tax in Queensland would be $4,500, and in Victoria, $4,650. So that's obviously slightly higher in Victoria. So I guess it depends on what you're looking at. I remember doing a calc, and I might have posted about this on LinkedIn or Twitter. I remember doing a calc for a client that already held an investment property in Queensland, and we are going to buy another investment property. I think he might have lived in Melbourne, in Victoria, and it worked out cheaper to buy the property in Victoria rather than Queensland, just because land tax is a marginal rate system. The more land you add, the higher the rate of land tax there is. And so that's an interesting one as well. So you need to think about, do you have any other assets? Will you have any other assets in other states down the track, and how will that sort of impact? But to go back to your question, apart from, in terms of holding costs, apart from land tax, what else should you consider with Melbourne versus Brisbane, or Melbourne versus other geographical markets? The rental yields tend to be a bit lower in Melbourne, and that is true, although that the gap might be closing a little bit between Brisbane and Melbourne, partly because Brisbane's growth has been pretty strong, in more recent years, really since the end of 2018. I think 2019, that market really started to kick off. And so the values of property have been rising much faster than the rents. And so the yields compressed. So I think there would be a little bit difference. Tenancy reforms, no, I think they're both both challenging markets to operate in. Not challenging, I mean, you got to do the right thing. I've got properties in both those jurisdictions. I don't really see from a landlord perspective that they're different from a tenancy reform perspective. But it's really about sort of balancing those things out. I guess, the other thing I like to think about when comparing two markets is relative value as well. So what am I getting for my money, relative to both markets? So if I've got a budget of $1 million, where does that put me in Brisbane, and where does that put me in Melbourne? What type of asset, And part of this is not very quantitative, it's very qualitative. So this is the art part of investing and working out, do I get better bang for buck? I'm not just talking about land size or necessary location and distance from CBD. They're all considerations, but it's not one of these things. It's just a general sense of, what am I buying, and what do I think the intrinsic value of that asset is? What is the past returns and so forth? So I think Melbourne offers pretty good value relative to Brisbane. I'm not saying it's cheaper, that you're going to get more for your money in Melbourne, but I think relative, if you're comparing two very different capital cities, particularly in population size, but the holding costs should be broadly similar, save for land tax, depending on what other holdings you have. But thanks for your question, Kieran. It's a good one, and we've got to be cognizant of land tax, because often when investors first invest, they don't even think about it. They probably don't even have to pay it. And, that's the other thing too, I guess, in Brisbane, the land tax free threshold is much higher. You're going to pay some land tax almost irrespective of the property you buy in Victoria. Whereas you can own $600,000 of land in Brisbane or Queensland without paying a cent of land tax. So it is insidious. It creeps up on us. And I've had certainly plenty of situations where clients have property in certain ownership structures that they've held for a very long period of time, and the land tax becomes a problem. And it might have been an avoidable problem if they had that foresight, 20 or 30 years earlier. So it's just one of many considerations. I'm not saying you should structure everything solely around land tax, but certainly one of those considerations. Great question, Kieran. If anyone has any more questions or feedback or anything like that, you can send it to me at questions@investopoly.com.au. As I said, between now and Christmas, and even over Christmas, I'm going to try and smash out as many answers to these questions as possible. So please keep them coming, and I look forward to receiving and answering them. And again, just as a reminder, if you enjoy this podcast, please share and recommend anyone else that you think might benefit from it to listen in. I'd greatly appreciate you spreading the word. Thanks so much, and until tomorrow, bye for now.